G. Calculate the flexible budget variance by comparing actual results to the flexible budget. Flexible budget variance isolates controllable performance. It is calculated as actual results minus flexible budget amounts, where the flexible budget is adjusted to the actual activity level. This ensures that comparisons reflect performance differences rather than volume changes. Interpretation distinguishes favorable and unfavorable outcomes. A favorable variance occurs when actual revenues exceed or actual costs are less than the flexible budget. An unfavorable variance reflects the opposite. This approach enhances managerial insight. By eliminating distortions caused by activity level differences, the flexible budget variance provides a more accurate basis for evaluating cost control and operational efficiency. H. Investigate flexible budget variances for price and quantity differences. Variance decomposition improves diagnostic accuracy. Flexible budget variances can be separated into price, rate, and quantity, efficiency, components. This helps determine whether deviations arise from paying different prices or using different input quantities. Price variances reflect market or purchasing factors. Differences between actual and standard input prices may result from supplier negotiations, market fluctuations, or labor contract changes. Quantity variances indicate operational efficiency. Variances in material usage or labor hours often result from waste, machine inefficiencies, poor supervision, or improved productivity, guiding corrective action. 1. Explain variance reporting in a management by exception environment. Management by exception focuses on significant deviations. Rather than reviewing all results, managers concentrate on material variances that exceed predefined thresholds, improving efficiency in oversight. Variance reports highlight areas needing attention. Reports summarize favorable and unfavorable deviations, enabling managers to identify operational weaknesses or unexpected trends. This approach supports timely corrective action. By prioritizing significant issues, management can allocate attention and resources efficiently, promoting continuous performance improvement without unnecessary analysis of minor differences. J. Define a standard costing system and reasons for adoption. A standard costing system assigns predetermined costs. Standard costs for materials, labor, and overhead are established in advance and used to value inventory and measure performance against benchmarks. Standards facilitate cost control and planning. They provide clear performance expectations and enable systematic variance analysis to identify operational inefficiencies. Adoption enhances performance measurement and motivation. Standard costs simplify bookkeeping, support budgeting processes, and create accountability by setting measurable cost targets aligned with organizational goals. K. Demonstrate and calculate price, rate variances for direct materials and labor. Direct materials price variance measures input cost differences. It is calculated as actual price minus standard price times actual quantity purchased or used. This variance reflects purchasing effectiveness and market price changes. Direct labor rate variance measures wage differences. It equals actual rate minus standard rate times actual hours worked. This reflects labor contract terms, overtime premiums, or workforce skill mix changes. Price variances isolate cost control effectiveness. They indicate whether management successfully controlled input prices independent of usage efficiency. L. Demonstrate and calculate efficiency, usage variances for materials and labor. Direct materials usage variance measures quantity efficiency. It equals actual quantity used minus standard quantity allowed times standard price. This reflects production waste, spoilage, or process improvements. Direct labor efficiency variance measures productivity differences. It equals actual hours minus standard hours allowed times standard rate. This variance indicates workforce efficiency or operational disruptions. Efficiency variances support operational improvement. Identifying root causes such as training deficiencies or process inefficiencies enhances cost control and productivity management. M. Demonstrate spending and efficiency variances for fixed and variable overhead. Variable overhead includes spending and efficiency variances. The spending variance equals actual variable overhead minus actual hours times standard variable rate. The efficiency variance equals actual hours minus standard hours allowed times standard variable rate. Fixed overhead includes spending and volume variances. The spending variance reflects differences between actual and budgeted fixed overhead. The volume variance measures under or overabsorption based on production levels relative to capacity. Overhead variance analysis supports capacity management. It helps management evaluate cost control effectiveness and assess whether production volume efficiently utilized available resources.